Most people hear the words passive income and immediately picture the ending instead of the beginning. They imagine waking up late on a Tuesday, pouring coffee slowly, glancing at a phone, and seeing money appear while they did absolutely nothing to deserve it that day. They picture the polished version, the finished machine, the part where the engine is already built and quietly running in the background. That picture is not exactly false. It is just missing the years that matter, because passive income is not where the story begins. Passive income is what shows up after you spend a long time doing the unglamorous work of building the machine that can eventually pay you while you sleep. That is what people keep trying to skip. They want the part where the dividend lands. They do not want the part where the first payment is so small it feels almost insulting. They want the part where the real estate check arrives. They do not want the part where their emergency fund sits there doing almost nothing except protecting them from disaster. They want the options premium. They do not want the years it takes to build the 100-share position that makes the premium even possible. This is why I think passive income is one of the most misunderstood ideas in all of personal finance. The public treats it like a trick. The wealthy treat it like construction. I have always preferred the second way of thinking, because construction is how fortunes are actually built, not through one miraculous asset, not through one magical yield, not through one late night promise that some system will replace your paycheck in 90 days. Fortunes are built by stacking a series of sensible financial structures in the correct order, until the whole thing begins throwing off cash on its own. That is what passive income really is. A machine built slowly enough that most impatient people quit before it becomes visible. Now, let me say something that many people do not want to hear, especially younger people just beginning to think seriously about money. In the early years, your main job is not passive income. It is active income. That is the truth. If you are at the beginning, the biggest lever in your life is not a dividend stock or a bond fund or a REIT. It is your own ability to earn more skill, more value, more leverage in the labor market, better positioning, better judgment, better work, better pay. The passive machine cannot feed itself when it is tiny. In the beginning, it needs fuel. That fuel comes from the money you earn with your labor. That is why I always tell people the same thing. First, grow what you can earn. Then, protect what you have earned. Then, convert what you do not need today into ownership. And then, much later than you wish, ownership begins to pay you enough that your dependence on labor starts to weaken. That is the sequence. Most people reverse it. They chase passive income first because it feels emotionally cleaner. It sounds like freedom. It sounds like escape. But if you chase passive income before you have meaningful active income, all you are really doing is trying to build a large machine with no fuel. That is why the progress feels so slow for so many people. Now, if I were starting over from zero, I would not begin by asking, what is the highest yield thing I can buy? That is exactly the wrong question. The right question is, what are the first accounts and asset types that let me build this machine in the right order? For me, that order is very simple. First, a high-yield cash reserve. Second, a brokerage account built around broad ownership and dividend, producing assets. Third, only after the portfolio is large enough, the use of covered calls on assets I already own. That is the ladder. And it matters very much that it is a ladder, because every rung depends on the one before it. The first rung is the one almost nobody respects enough. Cash, not idle, sloppy cash, sitting in some bank account that pays nothing and leaks away through impulse spending. I mean, deliberate reserve cash parked in a place that actually pays something reasonable and exists for one purpose: to keep your life from falling apart when the world reminds you it has no interest in your financial plans. That is the job of a high-yield savings account. The reason I start there is not because it will make you rich. It will not. The reason I start there is because nothing else works properly without it. A household without reserves is not truly investing. It is hoping. It is one bad transmission, one medical bill, one layoff, one emergency flight, one broken appliance away from being forced to liquidate assets at exactly the wrong time. That is not a small risk. That is one of the biggest reasons ordinary people never get the compounding they were promised. They keep interrupting the compounding because life keeps happening, and they never built a real buffer between bad luck and their investments. This is why I say your first passive income stream is not exciting income, it is defensive income. You move your reserve cash into a high-yield account, not because the interest will transform your life next month, but because it serves two jobs at the same time. It pays you more than your checking account pays, which is a laughably low bar, and it moves your reserve money out of the blast radius of your daily spending habits. That second part matters more than the first. A lot of people think the problem with leaving money in a checking account is just the low interest. That is not the only problem. The bigger problem is proximity. Money sitting next to your debit card, your impulse purchases, your dinners out, your random online orders, your little emotional leaks, is money that is constantly being tempted out of its future purpose and back into present consumption. When you move that money out, you are not just improving yield, you are improving behavior. And behavior is what changes wealth. Now, the interest does begin to matter. A few $1,000s turns into a small monthly payment. $10,000 starts to feel tangible. $20,000 or more can produce a monthly amount that no one will retire on, but that no serious person should dismiss. More importantly, by the time you have that much parked in a real reserve account, you have done something emotionally profound. You have stopped living at the mercy of every surprise that changes how you think, that changes how you work, that changes how much risk you can take, where risk is actually worth taking. This is why I think of a high-yield account as the financial equivalent of a foundation. Nobody admires foundations, but a beautiful house without one is still a bad house. Now, once the emergency fund exists, once there is real buffer between your household and randomness, the next rung matters much more. Ownership. This is where the brokerage account comes in. A brokerage account is just a container, but what sits inside the container determines almost everything about your future. I have always believed that the great divide in personal finance is not between people who budget and people who do not. It is between people who own productive assets and people who spend their whole lives trying to save their way into freedom. You cannot save your way into serious freedom in cash alone. At some point, the money must own something. Businesses' claims on profits, claims on future growth, claims on cash flows the economy keeps producing long after your workday ends. That is why the brokerage account matters so much. It is the account where your labor begins to transform into ownership. Now, a lot of people at this stage do something foolish. They immediately start hunting for the perfect stock. They want the next Nvidia, the next Palantir, the next explosive winner that will make all their previous income limitations irrelevant. That is understandable. It is also one of the fastest ways to turn investing into another form of gambling. If you are a beginner, I would much rather see you own broad, durable ETFs than a handful of stories you barely understand. A broad ETF lets you own a wide set of businesses at once. It lowers the probability that one bad earnings report, one weak CEO, one stupid acquisition, or one industry surprise wrecks your progress. It allows you to benefit from the compounding power of business ownership without requiring you to believe you have some rare gift for stock picking. That is why broad ETFs remain one of the most intelligent starting points for almost everyone. Now, within the brokerage account, there is a second layer: dividend-paying assets. This is where the passive income dream begins to feel real for the first time. Not because the payments are large, because they are visible. That matters psychologically. The first time you receive a dividend, the amount will probably disappoint you if you expected fireworks. It may be a few dollars, it may buy dinner for one person. If you are lucky, it may not even buy lunch. But that is not the point. The point is that you now own something that produced cash simply because you owned it. That is a very important feeling, because once you feel it once, you stop treating investing as a pure abstraction. You begin understanding what it means to own a real cash-producing machine. Dividend stocks and dividend ETFs can both serve that purpose. Personally, I think most people are better off beginning with dividend ETFs, rather than trying to build a portfolio of individual dividend names from scratch. The reason is simple. Diversification is underrated. If you buy one dividend company, your result depends heavily on that one company's future discipline. If management stumbles, if the balance sheet weakens, if the industry changes, your income is at risk. But if you own a diversified dividend fund, then the income is spread across many companies and many business models. It is not bulletproof. It is simply less fragile. And when you are building a passive income machine from zero, reducing fragility matters more than sounding sophisticated. Now, I do want to say something important here because the temptation is very strong. Do not chase yield blindly. A lot of people see a dividend ETF or stock with a giant yield and think they have found the shortcut. Usually they have found the trap. Very high yields often exist because something underneath is weak, distressed, or using complexity to manufacture a payout that looks irresistible to people who do not read carefully. There is no free lunch here. If the payout looks dramatically better than everything around it, there is probably a reason. I would much rather own a fund or a company with a more modest but sustainable yield, paired with real long-term growth than a flashy payout that flatters me for 6 months and betrays me in year 2. This is where passive income beginners often get themselves into trouble. They think they are optimizing income. What they are really doing is increasing fragility. Good passive income is not maximum payout. Good passive income is durable payout attached to durable assets. That is a completely different standard. Now, if you build this second rung correctly, something very interesting starts to happen over time. The account grows from 2 directions at once. The underlying assets may appreciate, and the cash those assets pay may also rise. That is what people often miss. A strong dividend strategy is not just about current income. It is about the possibility that the asset base and the income stream both expand together as years pass. That is why the comparison to real estate is so useful. A good rental property can rise in value while rent also rises over time. A good dividend ETF or portfolio can do something similar. The asset value may grow and the income paid out by that asset base may grow as well. Over a long enough period, the compounding becomes very powerful. But again, it is slow. It feels small at first. That is why most people never get there. They are too busy looking for something that feels large on day one. Now let us imagine you have done these first 2 steps properly. You grew your active income, you built the emergency reserve, you started buying broad and dividend producing assets in a brokerage account. Years pass. The account becomes meaningful then, and only then. The third rung becomes interesting. Covered calls. This is the rung people are always too eager to start with because it sounds advanced. That is usually a warning sign. In finance, the things that sound most advanced often attract people whose real problem is that they are still trying to shortcut the slow part. A covered call is useful, but it is not the foundation. The reason it works is simple. You already own at least 100 shares of something, usually a highly liquid ETF or a strong large cap company. You then sell someone else the right to buy your shares at a certain strike price by a certain date. In exchange, you receive a premium. Now, if the stock or ETF stays below that strike, you keep both your shares and the premium. If it goes above the strike, your shares may be called away, but you still keep the premium. In plain English, you are getting paid today in exchange for giving up some upside tomorrow. That can be a perfectly sensible trade. If the asset position is large, the strike is chosen intelligently, and the investor understands exactly what he is sacrificing. That last part matters most. Covered calls are not free money. They are trade-offs. You are adding an income layer to an existing ownership base. That is why I like them only after the account is already strong. Because if the account is not strong, the investor usually ends up treating covered calls like a hustle rather than an enhancement. He starts chasing premiums. He starts making trades because he wants the cash flow now rather than because the position structure makes sense. He starts building the roof before the walls are stable. That is when advanced tools become destructive. If, however, you already own broad liquid assets, if you understand that being called away is possible, and if the premiums are simply one more stream layered onto an already functioning portfolio, then covered calls can be a very elegant way of turning ownership into a more active income machine. Again, notice the sequencing. The high-yield reserve protects the household. The brokerage account builds ownership. The dividend layer introduces cash flow. The covered call layer enhances cash flow further. This is not random. This is architecture. And architecture is what wealthy people understand much better than everyone else. The public keeps looking for the one thing that will do everything. The rich usually build systems where each layer solves a different problem. One layer protects liquidity. One layer compounds capital. One layer generates distributions. One layer enhances distributions. All of it together becomes far more stable than any single trick ever could. That is the real secret, not the asset. The structure, now, if you zoom out over 10 years, the results stop looking trivial. The emergency account may be generating a modest monthly amount while protecting the household from catastrophe. The dividend layer may be generating quarterly cash that becomes large enough to notice and eventually meaningful enough to use the covered calls. Once the position sizes are large enough, may add another monthly stream. None of these streams alone may look glamorous compared to the fantasies people sell online, but together they begin to change the shape of a life. That is what passive income is supposed to do. Not replace all work in 6 months. Change the shape of dependence over time. That is a much stronger and more believable goal. Now, I want to be honest about one final thing. Passive income is never fully passive when you are building it. In the beginning, it is deeply active. You are earning, saving, learning, resisting consumption, transferring cash, reading just enough to avoid stupidity, deciding what to own, Sticking with the plan even when the payments feel too small to matter, that is work, necessary work. The passive part comes later after the machinery exists. That is why I think the phrase passive income sometimes does more harm than good. It makes people think the work disappears. The truth is that the type of work changes. You work very actively up front so that later your assets can work more actively than your labor does. That is the bargain. And I think it is a very good one. If I were starting from zero, I would not waste time fantasizing about quitting my job from one magical investment. I would focus on building the ladder properly. A reserve that keeps life stable, a brokerage account that turns labor into ownership, a dividend layer that proves the ownership is paying, then later an options layer that enhances the output of what is already there. That is how I would build passive income fast. If by fast you mean as fast as reality allows, rather than as fast as marketing promises. And that, in my experience, is the only kind of fast that is actually worth believing.